Okay, so let's look at this Lululemon trade, and we're going to kind of talk about how you as a trader can get caught in what I call like a trap trade. And if you're not aware of it, it can be detrimental to your account, and it can put you in a bad position. So I'm going to show you this through my eyes. This is not investment advice, but this is how I will look at trades. And this is something that I talked about this year, was to put myself in the best position to make easy trades. Now, if you want to kind of get a better understanding of how to get the life that you desire by leveraging the options market, I want to really encourage you to look at www.thehighestpaid.online. It's an options trading academy. And I very much are going to start. What I'm going to talk about in this video is very much how we've been successful in showing people, how to look at the market, how to observe a lot of the elements in the market to put themselves in the best position to be successful so they can get what they want. But it is not for people that don't want to learn, they don't want to read, they don't want to study, and they don't want to apply themselves, right? That's what we're going to kind of talk about. Now, looking at this particular trade, this is from Lululemon. They're a kind of like a yoga, but I would call them like an athletics company. They make a lot of athletic gear, but primarily based around the yoga space. They're primarily targeted at women, and they're primarily targeted at women that I wouldn't necessarily say upper income, but they're not targeted. They're not going after the same women's market. They're not going after what I would call a discount or a lower end women's market. Let me just go ahead and say it that way. They reported earnings on the 8th. Earnings were decent. However, what we showed is that they have almost an 89% increase in their inventory year to year, which means that even though the sales were there, they have too much inventory in relation to their sales, which could impact them over the future. Now, if we look at Lululemon over the 1 year, right? So let me go ahead and break down my points. What's my first point? My first point, if you look at the chart over the year, we're kind of getting a good understanding. So we're looking at the 1 year chart on the daily. I got the 200-day moving average up. I got the 50-day moving average up. Now, what did we see right before earnings? What we saw was that on the 1 year on the daily, Lululemon was above the 200 and also was above the 50, and the 50 was moving above the 200, right? And that was before earnings. That's on the yearly on the 1 day chart. If we looked at it on the weekly, it was also still above on the weekly candle on the 1 year, above the 200 and above the 50. So what people were saying is that they were willing to pay that higher and higher price as time went on. They were willing to pay higher than the 200-day moving average, and they were willing to pay higher than the 50-day moving average. Okay, so they reported earnings. We had a red day on the close, and we got a gap down, right? So we closed at 374 and we opened up today at 344. Big gap down. It exceeded its implied move on earnings. So those put contracts really appreciated a lot in value. And one thing we want to show you is that this gap got closed, right? So is that my first point? Make sure I'm hitting my first points, right? So most gaps get closed is the first point. We're seeing is that this gap here, right, got closed. Right. So it took some time, but from this gap up, this gap got closed. Right in between here. So we're finally seeing this gap get closed. But what are we seeing now? We still have this big gap down, which means what do we believe eventually? This gap is going to get closed. Now, so we're seeing our first kind of like trap is that it came down to close one gap, but because it gapped down so hard to close the gap, it created another gap. Now, what do we know? Well, what do we believe? We believe that gap's eventually going to get closed. Because I'm operating under that belief system, it could impact how I try to trade this. And I'm going to show you what I'm talking about, right? Now, what's my next point? We have some historical resistance. So I'm going to put that up there, then I'm going to show you. I'm going to take it off here to show you what I mean by historical resistance. Okay, so what I mean by historical resistance is that if we go on the 1 year and we zoom out, we see that once it gets around $400, right? We can see here, once it gets around 400, it sells back down. And we've seen that pretty much since 2022. We hit 400 around here. Late in the year 2021, it sold all the way down. We got back up to 400 around January, February, March, April. Around April, we sold all the way back down. We rejected even 350 here. And then we got around 380 right earlier this month, and then we sold back down as we started to run into earnings, right? So what do we know? Historically, since last year, we've been rejecting 400. okay? And the market is telling us that regardless of whatever the news is, we don't believe that Lululemon, based on sales, inventory, their guidance is worth more than $400 per share, okay? Now we have that as a historical resistance. And that's something that I want you to take into account, because you want to kind of always understand what price has been rejected at before. Now, if I'm looking at buying contracts, I'm going to always take that into regard, because why? I want to try to make the easiest play possible. Okay? I want to try to make the easiest play possible. And I think this is what a lot of people miss, just trying to get in on the deal, right? Because if we look at this on the 1 day, let's go here. We see the gap down, right? But what we see is just a lot of consolidation. So the market currently is uncertain as to whether to move this price higher or move it lower. We see the open at around, let's say in the 340s. It got all the way down to 325 earlier this morning. And then we're just trading in this really tight range. So the market is telling us we don't know what direction to take this price. We haven't seen it continue to sell off, right? But it also hasn't moved up to close this gap over the day. It may do it later this day, you never know, because we're just at 12:57 Eastern Standard. But we want to always understand that resistance, okay? Let me see what my next point is. My next point is IV reset because of earnings, right? Now, what we had is that they put the earnings out, they put out their guidance. Now, IVs are going to get reset by market makers based on that. They're going to reset the implied movement forecast. What you also have to understand, though, right, is they're also going to reset that on the weekly level. So we're going to get what we call weekly IV reset. Today's Friday. They're going to, this weekend, when the market opens back up, change the IV again, especially on the shorter term contracts. We're going to get an IV reset because of what happened yesterday. And we're going to get an IV reset again on Monday, because on the weeklies, we are going to forecast in what we believe the implied movement. Now we're going into a CPI print. We're going into a FOMC movement, a FOMC meeting. The market makers may feel like that can create bearish movement on the ticker. They may feel like it might create bullish movement. You never know. But we are going to get a weekly IV reset. These are the things that you want to take into consideration if you're looking at this play. Now, I would be looking at this play to continue to sell off. But I have to factor in IV reset because of earnings. I have to factor in weekly IV reset, right? I have to factor in most gaps get closed eventually. Also have to factor in historical resistance, right? The question is, how do we buy safety? In my opinion, how would I buy safety, right? So I should change that. How would I buy safety? I would buy safety by trying to buy as much state as possible. I would try to buy in the money strike so I could buy intrinsic value. And then I would try to buy a high open interest so I can make sure that there's a market and there's liquidity around that particular strike. High open interest, I would define that being 1K or greater, right? It may not be 1K, but I would define it, right? Everybody has their own definition. And that's what I would try to buy safety. The question is, do those contracts exist? And one of the things you see if you're looking at their options chain, and this is just going to be on Yahoo, so it's not going to be 100% accurate. So we go out to the 16th, right? We don't see a lot of open interest except maybe like on the 310. The 320 is not bad, but I wouldn't want to buy that contract. Why? Because we talked about before, gap's going to always get closed. If this contract, if this particular ticker consolidates or moves up next week, it's going to destroy the puts because the implied movement has already been factored in. Right, so the market makers woke up, they changed the IV on the contract. They're going to change the IV again on Monday. The implied move has already been baked into the contract. If I don't get that implied move on the weekly contract, it's going to start to erode my premium on the put. Let's look at December 23rd. I don't see a lot of high open interest, right? I don't see a lot of high open interest. The premiums have gone up a lot, but I don't see a lot of high open interest, which means I can take a haircut trying to exit the play, even if I get the implied move, because look how wide the spreads are. These spreads are fairly wide, right? Look how wide. This is the bid, this is the ask, right? The spreads are pretty wide. They're not terrible, but they're also not really, really tight. Look at December 30th, right? Same thing. Now, if I'm trying to buy as much state as possible, let's say I look at the June contracts. And if you look at them, you still don't see a lot of open interest. You see a 413 on the 250, but what am I? I'm way out of the money. Therefore, I can't get a lot of intrinsic value. I'm buying theta, but I'm buying a lot of extrinsic value. So I would need the price to start to move in that direction. It doesn't have to move fast though, because I got so much theta. But at this moment, 70 points out of the money, right? Same thing with the September 15th. Not a lot of open interest on any of the contracts, right? The at the money 330, there's 93 open interest, right? Look at the spread. Spreads aren't bad, right? Spread's not terrible, but I would need everything to go my way though, because if it goes against me, the spreads can get even worse. Let's look at the January 20th, 2024, same thing. And what we're seeing is that there's not a really, for this ticker, the options market is really not that liquid. It's just not. The volume on the ticker is really liquid. Right? We're going to get above normal volume, but if you look at its daily volume, it's decent 1.4. Today is 6, but it's 1.5. It's mostly not that liquid. We'll look at the float. The float is 117 million. It's not really that big of a float. Float's not bad, but it's not that big, right? And it's not being shorted. So what we're seeing today is just a sell-off because it's not being heavily shorted. But that's what I mean by when I say that I try to take easy plays. What you got to understand is that hard plays are hard for a reason, right? They're hard for a reason. What do I mean by that? They're hard because they're designed not to get involved in it. You don't see a lot of options mispricing. Even if you did see a lot of options mispricing, well, I'll put it like this. I don't see a lot of options mispricing. Even if I did see a lot of options mispricing, I don't see a lot of open interest on plays that I could find that could be very much in the money. Let's look at the 2025 contracts. The same thing. The only open interest I see is on really, really short, weeklies, maybe a week or so. Even the 23rd, which is right before Christmas, December 30th, still don't see a lot of open interest. The majority of the open interest that I see so far, and I could use like a scanner and it could really pull out the highest open interest contracts. But what I'm seeing with this initial look is the highest open interest. This is weird, the way their chain is this short. The highest open interest I'm seeing is on the 16th, which is next week. And that's really designed, in my opinion, to try to bait people into these contracts, assuming that next week is going to open lower. It's going to continue to sell off next week. But the contract to be in was this one right here, this 350. Right? This was the contract to be in. And then you could have exited out today and it increased 200% on the open. This is the contract to be in, right? Or the 330. Because this volume, if it stays in it, will move here. But these still are December 16th contracts. This was the contract to be in before earnings, right? Or maybe the 340, even though the open interest. But this was really the contract to be in because it's a 350 put, and we can show that. Let's look on the 5-day, right? It closed yesterday at around 375, right? So the 350s opened already in the money. So they were out of the money if you bought them, but they opened in the money. But that really was kind of like the contract to be in for the 16th expiration. Let's look at the 9th. The 330 and the 350 again was a contract to be in, maybe the 340. But these are very dangerous contracts. Why? Because if you don't get that movement, the contracts are essentially going to lose a lot of premium really rapidly because you don't get the implied movement. And that's what I mean by I look for easy plays this year. This would have been the type of play maybe 2-3 years ago. I would have tried to figure out how to make it work because my conviction on it would have been so strong. I would have took a lot of risks to be in a contract just with the hope that it would work. But if you see that looking at the situation, it's a very difficult situation to be in. Therefore, even if everything goes your way, it's still just a difficult situation to be in because the way the situation is set up. You don't get a lot of open interest on the contracts. There's not a lot of liquidity on the options chain. Therefore, you're seeing that I would be put myself in a tough situation with the hope that it can work. Not because I don't understand how to trade, not because I don't understand what I'm doing, is that I'm not really practicing, in my opinion, really good risk management. There's going to be an easier play than this, right? There's going to be easier plays than this. And that's something that I've seen people struggle with, to where even though they know how to trade, they go after the hardest plays because they get the most emotional fulfillment from doing something extremely hard, which is cool. But understand that you're doing something extremely hard with your money. And if you were trading for somebody else with their money, they may tell you not to take this trade because of the way in which it's situated. This might be a better short, right, with shares or equity than it could be with options contracts. And you got to always be able to weigh both in, which is why over the next year to probably 2 years, I may get more into shorting, because I've left a lot of money on the table because I'm not shorting with shares. But then I got to run a big margin account, which is a whole nother animal, right? And I'm not advising you to do it because you may not be able to handle that emotionally or psychologically or financially. I would encourage you to do what you know you can do based on where you're currently at right now. The market's not going to go anywhere. It's going to be here when we're gone. I can guarantee you that. Hope you got some value from it. But we want to kind of talk about trap plays that people get caught into. It's very impromptu, but this is the type of work I do on the day in, the day out. And these are the type of conversations I have with people that can actually understand the conversation, and I can get value from them and they can get value from me, and yada, yada, yada. Because I'm just trying to figure out how to derive more money out of the market based on my understanding of the market, right? And then I can apply this to every market. I can apply this same analysis to real estate, I can apply the same analysis to the bond market. So I just don't work 8 hours a day for wages. My life don't work that way. And no disrespect to people that life does work that way. I'm happy for them. We were talking about the other day, a wage earner, right? A salary guy getting $5 million a year plus incentives. So that's working for that guy. And I'm happy for him. Everybody got to find a lane in this. But the reason why I kind of look at things the way I look at it is because I have to make these type of decisions around capital. And it's a different decision than what the average person would have to make around capital, which is kind of why my analysis and my conversation and my communication is different. So if that appeals to you, hit me up. If not, I want to encourage you to just figure out how to be successful in what you're doing. David W. Williams, also known as Diamond Dave. I'll talk to you later.